Pretty much each day, we dive right into what's going on in the inflation world and how that affects home loan interest rates. We really need to get into something else today that I don't talk a lot about, and that is that there are more factors that affect home loan interest rates than just inflation. Inflation has definitely been the main contributing factor to home loan interest rates going up, but something else is happening in the background that is going to begin to take effect in probably March or April that will increase home loan interest rates. So you need to stick around because I'm going to have to take a little bit of time and educate you on how all of that works after we do our basic update here. Some people would just want the basic update, but I really do recommend that you stick around for a few more minutes while I explain to you what is happening here with the federal government and what they are doing to make home loan interest rates go up and why. So right now, let's take a look and see where we are. Overall, the market is really not having a great day today. We're down 22 basis points on the universal mortgage-backed security that we follow each day. Now, I'm pointing that out because we're going to get into that here a little bit deeper. So again, this is the mortgage-backed security that we follow every day. This is a basic conventional conforming home loan. The 10-year treasury, unfortunately, is up 9 basis points. We don't want to see either one of these situations. Now, take a look at the charts here. We've had a very good run. If you take a look at the basic, trajectory of where we've been going, this has been a great run for a while. But again, things don't go in a straight line. They go up, down, up, down, up, down. And right now, we're down a little bit under the trajectory line that we've been on. Now, that's not a problem. What we're really waiting for right now, first of all, today's Friday, and we always talk about that the banks tend to pull back and investors pull back a little bit, hedging their bets going into the weekend. Also, we are going to be getting number 2 out of our big 3 reports. I kind of say 4 sometimes, but the big 3 is the movements of the Federal Reserve to the federal funds rate, the personal consumption expenditures, and also the consumer price index. The personal consumption expenditures report is coming out on Friday of this coming week on the 27th, which I believe is going to be the next big move, whether we go up or down on our home loan interest rates. And I think we're going to go down on our home loan interest rates, and our mortgage-backed securities are going to have a good run. So let's take a look and see where we are as far as pricing on our scenarios. Again, this is the Brent Bruce Daily very well qualified 30-year fixed conventional home loan, which is currently sitting at 6.125% with no points, a little bit of a credit. Remember, we were at 5.99 yesterday. Let's close this one up. Let's go to this one here. What if we want to pay a little bit more to get down to that 5.99? It's going to cost a little bit more than a quarter of a point, about $1,000 with our scenario. Let's open up our scenario just to make sure that we're in compliance and show the numbers here. And again, yesterday we also ran the numbers for California instead of just Tennessee, and they were exactly the same, and that is consistent. Okay, so now let's take a look and get further into what is going on here. All right, so that was the basic report for today, January 20th of 2023. Right now, it is 2:49 p.m. Central Time. The market still has about an hour left before it closes, and we've been seeing this bounce between 20 and about 10. So not having a great day. But here's what we're going to get into a little bit further. So the federal government has a few things that they can do that affect home loan interest rates. A lot of people think that they hear on the news that, the Federal Reserve is going to raise mortgage rates. They don't raise mortgage rates, but they can influence them. Now, this is a situation, what I'm about to show you is a situation where the federal government comes in and directly changes home loan interest rates, which is very rare. So I'm going to show you some information here and how this works. Okay, so first of all, going back to this chart here, I mentioned that this is the universal mortgage-backed security, all right? The reason that it is a universal mortgage-backed security is because it can easily be sold and is underwritten according to the guidelines of both Fannie Mae and Freddie Mac. Okay, so you probably heard those names in the past, but I'm going to introduce you to someone who is even bigger than them. So the parent over Fannie Mae and Freddie Mac is the Federal Housing Finance Agency, okay? So the Federal Housing Finance Agency, if you read in here, it says they're responsible for the effective supervision, regulation, and housing mission oversight of Fannie Mae and Freddie Mac, okay? Now, I want to make sure that we point out very clearly this here, their housing mission, because that is what is coming into effect and is going to make a change to home loan interest rates. And I'll show you what I'm talking about. So again, if we take a look here, if somebody were to be an investor, now again, mortgage-backed securities and the 10-year treasury, those are bonds. Okay, they're basically, they're sold on the bond market. They're basically bonds. Okay, so if you're a bond investor and you have your money, you are going to look at two things. You're going to look at the return that you're going to get and the risk. So risk versus reward. Okay, so for instance, if I can buy a 10-year treasury that is backed by the full power of the United States government, you can feel pretty confident there's very little risk in getting your money back. So that's why right now you're getting an interest rate of 3.1488. Okay, I'm using general numbers, but right now let's say the interest rate is 3.488 for a 10-year treasury. Why would you take the risk of buying a mortgage-backed security, which is also a bond? Because that bond is going to give you a greater return. So more money. That's the way that you attract anybody. So if there's more risk, then you say, well, then I'll give you more reward, right? That's how this all works when it comes to the investment community. So they are going to give you a higher rate of interest in order to qualify for, or in order to attract your money. Okay. So how do we assess how much you should pay for that risk? So you don't know everything there is to know about mortgages and mortgage risk and defaults and all these different things that they're paying attention to. Well, if you've been around long enough, you know that, look, the lower the credit score, the higher the interest rate. Why is that? That's a very basic one, because lower credit scores indicate a higher propensity of default. So if I'm going to give you a mortgage, I want a higher rate of return because of the higher indicative value from your FICO score, the higher propensity to a default on that mortgage that basically I'm paying for. So I'm taking on more risk. Okay. So I want more reward. So I want a higher rate of interest. So who is it that sets these amounts? So in general, the person who's the entity that sets pricing for mortgages on straight conventional conforming loans, the vanilla loans, is the Federal Housing Finance Agency. So they have what are called loan level pricing adjustments, okay, LLPAs. We're going to get into that in greater detail right now, because that is what is changing home loan interest rates, okay? So again, the Federal Housing Finance Agency, the key here is that they also have the housing mission. So there is a mission, because this isn't just strictly business. This is also a governmental entity, which means they have an agenda. Okay, so they have an agenda that they need to stick to as well. So let's go over here and see a little bit more about the FHFA and Fannie Mae and Freddie Mac. Now, why does it matter? How much do Fannie Mae and Freddie Mac actually acquire of the mortgage world? In general, for 2020, they actually bought 62% of all home loans that were done in the United States. Okay, this is everything. This is the conforming market, which means it's a loan amount that is either at or less than the conforming loan limit that is set by the FHFA each year. So each year when I announce the new conforming loan limits, that is the FHFA that made that announcement, made that decision. So here you see that there's government loans that are about 23% of the market. Enterprise acquired, that's your Fannie Mae and Freddie Mac, 62%. Other conforming, 13%. That's going to be local banks, credit unions, things like that, that actually keep their mortgages instead of sell them to Fannie and Freddie. And then you have the jumbo market and others. You have non-QM, subprime, and things like that. So here's what's going on. Is that basically we talked here about loan level pricing adjustments. Now this chart, I'm going to show you what this means. The first thing that you need to understand, and I'm going to bring my face up here so that you see me say this very clearly. What I'm about to show you is not a chart that is adjusting interest rate. So when you see negative 0.35%, that is not an adjustment to the interest rate. That is an adjustment to the costs, the fees of a home loan. Okay, this is getting a little bit deeper into the weeds, but you need to understand because this is going to affect home loan interest rates in probably March or April, and they're going to go up in most cases. So when Fannie Mae and Freddie Mac make a loan, this is their vanilla loan. Okay, so we say, look, we're going to be, here's this loan, here's the price. Let's say the price is $0. Now, if you have a credit score that is lower than we want, then we're going to charge you more because there's higher risk. And if you're only going to put 3% down, then we're going to charge you more because there's higher risk. And if your debt ratio is extremely high, then we're going to charge you more because there's higher risk. Okay? That is what they do. They have a chart that kind of breaks all of that down. Same thing. If you come in and you say, but by the way, here's my loan at regular price, but I have extremely good credit. I have an 800 FICO score. Well, then we're going to charge you a little less. And by the way, I'm going to put 50% down on this house. Well, that's low risk, isn't it? We're going to charge you a little less. Okay, so they take the vanilla loan and then they adjust it based on risk factors. Okay, and the adjustments are called loan level pricing adjustments. All right, so what's going on here is the loan level pricing adjustments are being changed. And they're being changed in a way that, in general, is making it a little bit more expensive for that pretty well qualified client and a little less expensive for the client who is not quite as well qualified. So the pricing is getting cheaper for the lower FICO scores or maybe the lower down payment ranges, and it's getting more expensive for those that have better credit. Now, why would they do that? Because that really doesn't fit when it comes to risk versus reward, which is what the general market is truly looking at, because they have a mission. We talked about that in the other chart here. So because this entity also has a housing mission, and they're feeling that in order to accomplish the mission, they need to make housing more affordable for some of the people that are having a hard time being able to afford a house. Now, they're not going to make tremendous differences, but they will be noticeable. All right, so take a look and see what I'm talking about. So first of all, I'm going to send you links to all of this. So this is the basics of the Federal Housing Finance Agency. This talks about the percentages or whatever, the amount of loans that are sold to Fannie Mae and Freddie Mac. I'll have to get into why they exist on another day. But this chart here and this article here that was produced by the Mortgage News Daily and was sent to me by one of my good friends and partners, Danny Espinoza. Thank you. So a big shout out to Danny that pointed this out because this is a great chart. Now we hear about this going on, but the fact that they put this together in such a great chart is helpful. So you should read this completely to understand more about it. But right here, this is saying the new LLPAs versus the old LLPAs. And it's basically a heat chart. So if the loan level pricing adjustment is going up, then it's red, or it's orange, or it's lighter orange. So it's a heat chart. If the loan level pricing adjustment is going down, if the mortgage is going to get cheaper, then it's more of the green tones. So you can see that the green tones are down here in the lower FICO bands. And the red tones are up here in the middle to upper FICO bands. Now, this FICO band of 780, I don't believe that even existed previously. Once you were above 760, usually everything was the same. So 780 is a new FICO band. So you can see where, if you have a 780 FICO score, you see that this number, this 0.625, is lower than this number, which is 1.75. Now, again, this is not an interest rate adjustment. It is a pricing adjustment. So don't worry about these numbers. There's too much detail that I don't have enough time to explain at this point. But just know that these lower FICO bands are going to become less expensive. And look at this, especially in the lower FICO, lower down. So if you're only putting 3% down with a 639 or less FICO score, you're dark, dark, dark green. So they're making the most impact on this quadrant here. All right. So understand that this is something that is going to be coming out. And this is where the federal government, through the Federal Housing Finance Agency, is changing interest rates. changing the cost of a mortgage. Now, they're going to talk about the changing cost, but that cost is then pushed into the interest rate. And this is going to take effect. Let's take a look back here at the article. And it says in here that this applies to loans that are guaranteed by the agencies. The agencies are Fannie Mae and Freddie Mac, starting May 1st of 2023, which means that lenders will probably begin to implement this in March and April. So you will begin to start seeing minor adjustments to the middle grade or higher grade buyer, especially someone who's putting like 20% down, maybe 25% down. That's kind of that range that they are really kind of hitting with a little bit higher cost, but then making it less expensive for those in the lower FICO bands with lower down payment. All right. So I hope that you understand, or that clarifies what's going to be coming. Now, what does that mean to my general expectation of home loan interest rates going forward? Now, again, those were not interest rates. So it doesn't mean that interest rates are going to go up by 0.625%. That is not the case. Make sure that you understand that. Don't worry about the numbers. Just understand the premise of the fact that mortgage rates are going to go up a little bit or down a little bit. Okay. So what is it going to do to home loan interest rates? Realistically, all things being equal, maybe somebody who was getting in that middle band of putting 20% down and has a 720 FICO score, maybe it's going to cost 1/8% higher in interest rate, maybe 1/4% in interest rate. That's what it will equate to, somewhere in that range. Well, on the flip side, that person who's putting maybe 3% down and has a 640 FICO score, their interest rate might be 3/8 or 0.5% cheaper in rate once it all shakes out. So we'll have to see how this all plays out and how this all gets translated and filtered through the banks, because they also set pricing on top of that. But understand that this change is coming. I don't think that this is going to stop us from getting to the 4.875% interest rate on our conventional 30-year fixed mortgage by July the 1st. But take a look at another way that the federal government is making it more expensive for some people, less expensive for others, and something that just kind of comes out of nowhere. These are things that we're not really anticipating or looking at, and then they just say, hey, this is something that we're going to do. Let me know your thoughts. Let me know what you think about all of that. Do you have any questions? If you want me to go further into that, you can always call me as well to walk through it. I'll put a link to some of these articles here that also explain this information to you. Hopefully you're beginning to understand much, much more about the depth of what goes into home loans. I was going to get into guidelines here, but man, we're at 17 minutes already. So there's some guideline information that I thought was pretty interesting I wanted to show you as well. Have a great weekend, and I'll get back to you on Monday.